Hi guys, this side Rahul Magan here is a Group Chief Executive Officer Treasury Consulting and also a venture capitalist. Now today two great things happens. Number one, we got a call from an institution. I don't name this an institution, but this institution is in Ahmedabad where the US presidency Donald Trump today visited. So I got a call from a dean and at onset he was very angry. In fact, I never met that person. In fact, I was not aware. I know that institution exists. It's a well-known institution, but I was not aware that he is the dean of that institution. So he called me that, "Are you Rahul Magan?" I said, "Yes, I am Rahul Magan." Then he said that, first few lines, your channel is very good, you are very informative, and so on and so forth. Then he come to the point and said that, why are you uploading the videos which the faculties even do not teach? And then he said that only because of your videos, the students in our classes are asking questions from our faculties, and our faculties are coming to me and saying that the fees which you are basically the professional remuneration which you are paying to the faculties, to us, basically faculties asked to the dean that the professional remuneration you are paying to us is not sufficient to answer these technical questions put up by the students in a class. And he was referring to an incident whereby one student opened a YouTube video of mine in his class, basically a professor of finance, and said that Rahul Magan said that this kind of swap is also possible. Then you explain how it is possible. And then this dean told me, why don't you just upload the simplistic content on the YouTube and do not offer the exotic content? These are the dean of your institutions. I don't want you to name him in the public domain. I hope I have given you enough guess. They are charging 14 lakh plus from the students who are doing MBA. After his call, I went to his website and asked my team member to search how much they are charging for MBA. They are charging 14 lakh plus from per students for a MBA program. And even after charging 14 lakh rupees, they are not been able to provide a good quality faculty in finance to their students. Rather than acknowledging this fact, they are calling me from their landline number, and then they are more or less threatening me that I need to stop imposing the exotic content. But they do not know that Treasury Consulting is heading as a bank. And whatever we are offering on the YouTube channel is not even tip of an iceberg. It is tip of an iceberg of the wealth of the knowledge Treasury Consulting have. Only tip. So Mr. Dean, remember carefully, people like you do not matter to me, at least. Note that. Second good thing happened, which is that JP Morgan Chase is now entering as a digital bank in London, basically UK. That may be a surprising information for many, but we were aware about this news from quite some time, and that was expected to happen. JP Morgan Chase entry is not the only entry in the world of digital banking. I cannot name the people, but more than 8 plus big banks, those who are entering as a digital bank. I cannot confirm whether they will spin out, they will spin off, or they will hive out their digital banking architecture. Like JP Morgan Chase is more or less launching a separate architecture for digital banking, but it would be a cross-selling according to me. 8 plus big banks are currently under discussion to launch their independent digital banks, and 1 or 2 is launching digital banks in UK, 1 or 2 in UK, US, and rest are launching in the Southeast Asia. So eventually in the 3 or 4 months, remember my words that another 7 plus banks come in public domain and announce that they are heading as a digital bank. And if our information from Interbank is correct, then probably by end of this year, which is by end of 2020, it would be very, very, very difficult for digital banks, the new digital banks of any country to compete. because the way they made their model, debit card, credit card, multi-currency account, it is 5 minutes jobs for JP Morgan to replicate that model. You will see that probably in another 2020, digital banking failure would be the biggest news you have in the media. You remember my words right now, or take it in writing. I'm telling you right now. I cannot tell you the name. That's sorry for that, because it is confidential, but you will soon get to know. So today we are going to be talking about a very important topic which the CFA do not talk, which the FRM do not talk, which GARP and all such degrees do not talk. On paper, certified financial analyst, FRM, Faltu risk management and all such degrees offer a glimpse of that. Not more than a glimpse, in fact, to be honest. We're going to talk about a very important thing which is, I would say, which was there before 2008, which is there in 2020, and which would be there probably in 2080 also. I cannot comment the shape, size and outlook of these kind of deals. They may change, and it has definitely changed. That we're going to cover. So this is part 1 of the video, and this topic having say 2 parts minimum, part A and part B. So today we're going to talk about a very important strategy in a private equity market or investment banking market, which is known as leveraged buyouts. Shortly they are known as LBO. Having said that, if you open the Google and talk about leveraged buyout, there are ample of material which we have on leveraged buyout on Google. But unfortunate part is that no material, or hardly 1 or 2 PDFs anyone dare to cover the leveraged buyout in a very holistic way, completely. So if you're expecting us to cover, we will try and cover 50-60% of the leveraged buyout, and 100% cannot be covered because it's a very lengthy topic. Number 1, the biggest myth in the leveraged buyout is that it is led by the banks. I'm not saying this is completely wrong. Like, the largest leverage buyout happened in Indian history is by Tata Chorus, preferably speaking, when Mr. Ratan Tata, due to his ego, decided to go ahead with the Chorus, and he ready to have a leverage buyout of around 12 plus some billion dollars. I think, if I'm not mistaken, it was around 12.1 billion dollars. He hired many banks to get this done. Banks formed consortiums to make this leverage buyout happen. But this was long ago. So now this kind of models do not work. So basically the leverage buyout architecture of Tata Chorus is history. Because this architecture currently not in domain, and no bank in this globe can afford this architecture. For obvious reasons. Number 1, this architecture requires complete control of banks. Today, except few banks like Goldman, JP Morgan, say Citi, and very few banks left with capital in their balance sheet. And not everybody, in fact, most of the banks do not have capital in their balance sheet. So if you do not have capital in your balance sheet, participating in a leveraged buyout deal is definitely next to impossible. Secondly, every leveraged buyout deal is subject to 2 important issues, and no one in this whole globe can run from these 2 issues. Number one, which is the issue of accounting. Different accounting standards of the globe. In fact, IFRS, the universal standard, and the local standard, like local Australian standard, local UK standard, local Singapore standard, which is known as SFRS, Singapore Financial Reporting Standards, and local, like in India, INDAS, Indian Accounting Standards. They all are having different way of putting this leverage buyout compared to different way of putting by the IFRS. So accounting is an issue. Example, the way a leverage buyout is accounted in IFRS, it is not by the UK law. It is not by the Singapore law. Henceforth, what happens, that it creates an accounting mismatch. And that accounting mismatch, I understand, but not many understand. And hence, it will create a big mess on the cards. Second biggest issue we have in case of leverage buyout is the valuation. Valuation is always an interpretation issue. Like when Chorus deal was more or less finalized or in the public domain in the form of the leverage buyout, then I commented at that point of time that it is going to be a failed deal. And you can see yourself that today Tata Group total debt, which is around 2,50,000 crores, we're going to have a separate video in that regards. Out of 2,50,000 crores, only 3 companies are having substantial exposure to this debt. And out of these 3 companies, Tata Steel holds substantial exposure in these 3 companies. So if we exclude Tata Steel for a while, then the Tata debt, which is around 2,50,000 crore, would reduce considerably. Henceforth, I never say that the Ratan Tata is a very, very philanthropic person. Although people have an indemnification issue with me, let it be, I don't care. This is how. Now, private equity are those people, those who are themselves rich, Vanguard, KKR, I would say private equity player like PIMCO, private equity like Sequoia. There are those who take the money from others and they will invest. Example, Blackstone, BlackRock, Brookfield, and multiple. They take money from others who are known as HNI, high net worth individuals, and invest in these companies. But having said that, this raises a very, very important questions for most of the people. Till what extent you can take the money? And till what extent you can earn an interest on that money? But private equity replaced the banks. The reason is that private equity works better than banks. Because private equity board, even it is a small private equity, big private equity or super private equity, they believe only in one thing, profits. That is the reason in 2 cases in India. One is the Cafe Coffee Day and one is this Crompton Greaves. A single name comes, which is KKR. KKR is, by the way, big private equity player. KKR name comes in case of Cafe Coffee Day when the late, the owner of the Cafe Coffee Day before suicide wrote a clear letter that the KKR or Standard Chartered is torturing me a lot for interest. And it was KKR, by the way. It was not Standard Chartered. Even that in fact can come into public also, but nothing happened. Incredible India. Secondly, in the Crompton Greaves. In the Crompton Greaves case also, KKR not come into the public domain. Credit again goes to media. So today private equity replaced banks. Private equity entered as a leverage buyout in 3 ways. Number 1, they create a consortium. If the leverage buyout deals are very large, example 30 billion, 40 billion, 50 billion, although such kind of deals are very rare, but once in a blue moon, these deals will come. Like in 2000 and in 2000 when the Tata bought Chorus, no one expected that at that point of time it was the largest leverage buyout deal. God knows tomorrow some company wanted to buy another company and they expect, say Tesla. I'm just quoting a hypothetical example. Say Tesla wanted to buy General Motors, example, and General Motors willing to sell to Tesla for a minute and they demand $35 billion from Tesla. Tesla, who is already in losses, don't have the money, and Elon Musk, who always fly in the air, who dream of living in Mars, don't have the money. Now what he do? He going to create a leverage buyout because no venture capitalist will fund them, no credit line will fund them. He needs to create a leverage buyout. That leverage buyout cannot be supported by a bank. It would be supported by a private equity because no bank will fund to invest in automobile sector, considering when the electric vehicles are taking up and technology is changing and it is leading to the job losses. So consortium led private equity is very, very rare now, but I'm not saying that it cannot happen. Second is the private equity do himself. Basically there is a deal which is coming and suppose the value of the deal is $10 billion. Example, Blackstone. If there is a big deal of private equity come, of leverage buyout come, and suppose Blackstone is the only mandate player we have, then 10 billion is nothing for Blackstone. BlackRock, Brookfield, Cerberus, it is nothing for them. Canadian Pension Fund, CPPIB, it is nothing, no amount for them. So they independent. One is the private equity funds. in which what they do, they don't allow other players to come, they take the funds from them. Example, suppose, I'm just taking a hypothetical example, Tesla wanted to buy General Motors, and Tesla do not want it to be a consortium, by the way. So Elon Musk go to Blackstone chairman and said, we want 20 billion funding. Blackstone said 10 billion I can give from my pocket, but 10 billion I need to arrange. Okay, that 10 billion he created a separate fund and he sell it to his investors. His investors invest in this fund, but having said that, the whole credit risk of that $20 billion is on the Blackstone. It is not on the people, those who invested in the Blackstone. They don't know who is Tesla. Maybe they know, but officially they don't know who is Tesla, who is Elon Musk. They only know that if Blackstone will know, if Tesla defaults for a minute and Blackstone not been able to pay their share of $10 billion, then they will take from Blackstone by selling their asset. They have nothing to do with the Tesla. So this is called private equity funds. Last is the pooled investment vehicles. Pooled investment vehicles looks very fancy, but they are very tough. In country to country, they are very, very tough. So pooled investment vehicles, and major problem in the pooled investment vehicle is that the tranches are very small. Example, you can contribute 500. Example, Tesla wanted to buy General Motors. Tesla went to Blackstone. They want $20 billion. Rather than launching a fund, Blackstone launch a pooled investment fund. It means even if somebody would contribute $500, he can contribute. Somebody will contribute $1,000, he can contribute $1,000. Somebody contribute $2,000, he contribute $2,000. Somebody contribute 10 million, he contribute 10 million. So this is how it goes, which is pooled investment fund. So these are not comprehensive. This is not comprehensive list. The list is very long. Actually, it is too long that there are multiple models we can create leverage buyout. But the first step of the leverage buyout nowadays is to understand that how that private equity actually behaves. Now that private equity, to remind it again, can create a consortium. They can invest themselves from their own pocket. They can create a fund, which could be a shell company, or they can create a pooled investment vehicles. It depends. There are multiple ways through which funds can be yielded. We will talk about later. Funds can be raised. More importantly, when it comes to the important thing, how this deal happens, the number one step is the deal screening. And that is very tactful job, to be honest. That is a tactful job because deal screening requires humongous knowledge. You need to screen the deal in and out, which in our parlance known as end-to-end. You need to read the deal end-to-end and you need to get this done. So a small mistake can lead to multiple interpretation issues, and these interpretation issues may even reach to several $1 billion of conflict between two parties. So a very immaculate understanding of the deal screening is required. And that immaculate understanding of the deal screening is definitely not a one-night stand. That is sure. For that, you need to work years on years. You need to understand each and everything. Example, I don't know whether this CFA, Certified Financial Analyst, will teach you or not, but when a private equity fund a leverage buyout, the first preference is the limited liability partnership companies. They prefer creating a limited liability partnership company for that deal. So I don't know, when was the last time you ever visited the private equity players' annual report or you saw the annual report, but if you would have visited their annual report, you would got to know that they have so many SPVs in their book, special purpose vehicles. And why they do have so many SPVs in their book? Only because for every deal screening, they need to create, after deal screening is done, they need to create a limited liability partnership company. And that limited liability partnership company is linked to that SPV, which is also known as shell company structure. But the world having more than 208 countries, India, Singapore, say Indonesia, Canada, US having multiple states, Malaysia, Thailand, Dubai and all, and everyone having a different tax structure of limited liability partnership, and that keep changing. Like take an example of India. When the finance minister cut down the tax rate the limited liability partnership structure is become redundant now. We're going to have separate video now on that. So can any private equity player will prefer limited liability partnership in India? He cannot, provided he understood the recent tax cut in complete detailed and linked with DTCC, DTAA, which is double taxation avoidance. That is, so deal screening is very important, very important, and deal screening is the main important thing I would say the people do. But unfortunately, the books, the courses, the trainings do not teach you that. Henceforth, you are bound to fail. Second is the deal structuring. So you need to structure the deal. Example. 1 week before, we got a call, we got an email from a so-called private equity player from US. And he wants $400 million of standby letter of credit. Just now I wrote to him that this standby credit arrangement which you're talking it about, which in our parlance is known as standby structure, is impossible. Because your standby structure is having technical issues, and if I commit that this will happen, it will never happen. So I am not giving fake commitment, we reject the deal. And we propose him that the structure which you are proposing is wrong, you need to go with our structure because we know that will work. Structuring. If I start with the way he suggested, even though he is a private equity player, I am bound to lose. Deal structuring is very important, and that requires the complete understanding of FICC, fixed income currency and commodity /C, which is credit. If one do not have a complete understanding of this, then he is gone. He is definitely gone. So a very great understanding of FICC is required. The third is the fundraising. How are you going to raise the funds? Is the private equity going to be going solo? Are they going with a consortium? What kind of consortium they would like to go with? Last but not the least, are they going to make a shell company? And how they going to do? Fourth is the initial operations. If I am lending you, I want the operations to be managed by me. But you do not want operation to be managed by me because it led to the excessive interference from my side in your company. But at the end, my leg is higher because I am a private equity player, I am funding to you. So how the ops management will happen, how ops work, that everything needs to be mentioned in a very liquid and immaculate way. Last but not the least, we going to have the initial exit of private equity, and then we going to have the roll up. Now, what is initial exit? When a private equity invests in a LBO, leverage buyout, what they do after a period of the time, they quit. And then what they do, they bring some roll-up partner, which is known as refinancing roll-up, to take up that job. That roll-up partner might be the same private equity or it might be another private equity also. But that depends upon the agreement that refinancing roll-up is mentioned or not. If it is not mentioned, it will never happen. If it is mentioned, it will definitely happen. If it is mentioned, how it happens, in what circumstances it will happen, these are the things that we need to see. So this is the first part of the game whereby we discussed about private equity and the leverage buyout. In this leverage buyout, there are 4 ways. Either you can make a consortium, you can make a private equity can go solo, a private equity fund can be created, or pooled investment vehicles can be created. The number of steps include deal screening, deal structuring, fundraising, ops, initial exit, and refinancing roll-up. See you in the second part. If you have any query, you know my mobile number, which is +91 9899 978. You know my second mobile number, +91 9818 155. You know our fixed income platform, www.fixedincome.global. Have a great time. Of our video, which is leverage buyout. In this we're going to talk about that what are the 3 stages of leverage buyout. Now the number 1 stage is known as the leverage stage. in this leverage stage, we will see that how much we can leverage. So the borrower can ask for unlimited amount. He can even ask for $100 billion. But the lender or the consortium or the solo partner or the pooled investment fund, they need to see how much they can lend and whether that lending would be upfront or that lending would be in tranches. That they need to see. In majority of the transactions which are leveraged buyout, upfront funding is very rare. It is the tranches funding which happen. So no one expect that you're going to be billing say $30 billion at once. No one expect that. But once in blue moon, you find an equation whereby if you do upfront funding, you will get some discount from the seller rather than pay the tranches. And also a very important thing which is known as earn-out, that we'll talk after 5 minutes. Second is the growth, and that is subject to huge interpretation issues, especially when it comes to consortium. Because every bank, those who funding the consortium, will see the growth of that structure according to them. Some will see a very high growth. Example, Tesla. Tesla share price is trading at $800 per share. I strongly feel that Elon Musk is a kind of person who knows how to create bubble. I don't think Elon Musk is a creative person in the globe. Had it been, his company would be profitable. Steve Jobs was innovative. He launched product after product. iMac, iPod, iMac Airbook, iPhone and whatnot. Mr. Gates also launched product over product over product. Microsoft Cloud, Azure, and the sequence is very high. But if you look at Tesla, he did nothing out of it. But I'm damn sure there would be some private equity players, those who thinking that Tesla might be a great company. Oyo, Paytm, Zomato, Swiggy, venture capitalists are still funding them. In fact, you would be surprised to know that the SoftBank funded another $400 million to a company of India who is selling the baby products. Come on. How can a baby product company need $400 million? It's about 3,000 crores. And what do you expect from them? I think before cutting the check, the SoftBank never think that they are cutting a $400 million check. A baby care company, they are already in losses. And if you get $400 million funding, then you will never be in profit because you will turn extravagant. And how can you expect a baby care company be a unicorn? And that will losses. So it depends. The growth is something which is highly interpretation issue and everyone take this accordingly. The way I interpret Tesla, people don't. The way I interpret Apple, people don't. The way I interpret Microsoft, people don't. So it is subject to valuation issue. There is no doubt about that. But at the end, the whole system, the whole consortium needs to agree at some point of time and they need to take this forward. Though the situation is tough. Last is the arbitrage, and this is very important. In arbitrage, we will decide which instrument to offer and how. There are humongous amount of instrument, like I'll tell you 2 ways. Many people say that leverage buyout could be one option whereby company can go public. 99% people will see that how can a leveraged buyout transaction, a company can go public. And apparently speaking, this look like height of idiocy, but it is not. A company example, say Tesla got an offer from General Motors that General Motors wanted to sell his company in US and they wanted to wind up the business. By the way, it's an hypothetical example. It's the occurrence in the real life is just a coincidence. Tesla agreed and the total buyout is 30 billion. Suppose they agree at 30 billion. As usual, Tesla is in losses. They don't have the money. They go to BlackRock and they said, we wanted to participate. We wanted to buy General Motors. By the way, General Motors hold patents, they hold the machinery, they hold the instrument, they have plants, everything they do have. So more or less it's a ready-made deal. Blackstone said, we're not going to be fund you in debt. Because what is debt? You will show as a liability side, and after you pay out, probably after 15 years, Blackstone is having nothing except the interest. Blackstone say, we want foreign currency convertible bonds, or maybe local currency convertible bonds. Because General Motors is an American company, Tesla is an American company, funding is happening in dollars, so why take foreign currency for a minute? They say, let it be local currency convertible bonds. We will lend you in bonds in dollar terms. After 10 years, a small percentage of the bonds will mature and it will convert into equity of a joint company. And this is a swap strike ratio. So example, they agreed that behind every 2 bonds there would be 1 equity, or maybe any ratio. Alternatively, they come with a foreign currency convertible bond. They will say that cheapest route is not the US dollar, rather it is a Japanese yen. Everyone know. So let's go with the Japanese yen. I am giving you Japanese yen. Now the dollar to Japanese yen risk is on the Tesla, which they are going to be hedging that. With Blackstone or without Blackstone, we don't know. In this, the same structure will apply, assuming behind every 2 bonds there would be 1 equity. It means that after 50 years, say 15 years, suppose the deal is of 15 years, and after 10 years, the joint entity will give a equity to the Blackstone. It ultimately means they are going public. Another way of leverage buyout is that it's a complete debt structure. That Blackstone will pay, say, $30 billion to Tesla. Tesla pay this to General Motors. They buy General Motors. The debt will in the books of Tesla as per the agreement, and after within 15 years they need to pay. There is an amortization schedule. They need to follow that amortization schedule. Simple, no equity, simple plain debt. Of course, we have a huge structure. Example, we have secured and unsecured high yield bonds. We have senior secured debt. We have senior lien debt. We have mezzanine debt, and we have vendor financing. We have bridge funding also. This is how it happens. But we need to understand that there are few important clauses that a person who is looking forward to be an investment banker or the investment banker themselves need to read and act carefully. Like number 1, change in control provisions. What would if in this deal, after 2 months, Mr. Elon Musk stepped down for personal reasons and somebody else come into the picture? And he start making the noise that the 2:1, 2 bond per equity deal signed by the Elon Musk is incorrect. We're going to be revising that. Or what would if he make it more beneficial to Blackstone, say 1:1? This would have a deep impact on the Tesla share price because Tesla is a listed entity. Control provision. Second is the step up. Step up applicable in second scenario, assuming Tesla issued a bond in the favor of Blackstone and BlackRock, and BlackRock funded Blackstone funded. And what happened? Due to some eventuality, the credit rating of Tesla downgraded, and due to this downgrade, there is a credit risk on the Blackstone, which they never envisaged. What they do, they put a clause or a covenant called step up. When we funded you, your rating was BB plus, assuming. If it go to BB or BB minus, which means 1 notch down or 2 notch down, then the yield coupon which you are offering, assuming 2.5%, you will increase this by 50 bips. Means after every 1 notch down, the increase in the coupon is by 50 bips, but with every notch up, there is no cut in the coupon. This is step up provision. Then we have financial covenants, then we have account. The biggest problem in the leverage buyout is the accounting and the repricing risk, which is known as mark to market. Either it's a local currency convertible bond, either it's a foreign currency convertible bond, or either it's some secured, unsecured or exotic structure. The mark to market is supposed to happen. and that mark to market creates a repricing risk in the value of the Tesla, in the books of Tesla, and also in the books of Blackstone. For Blackstone, he is an owner of the fund. To Tesla, he is the borrower of the fund. So one would be positive, so one would be debit side, another would be credit side. So the debit entry of Blackstone would be the credit entry of Tesla, and vice versa. So leverage buyout is a very big and significant deal. It requires an exceptional knowledge. It requires an exceptional understanding of the financial market. It requires a very good tax consultant on the board who can come into the picture and explain that this country is offering this much tax liability, so it is conducive. It requires the valuation people who can value that instrument. It requires the financial markets expert, those who can tell that this instrument is not correct, rather you go with this instrument. So it's a pretty good important thing. But in the books like CFA, Certified Financial Analyst, FRM, Faltu Risk Management and all, the leverage buyout is presented in such a way that it is a 5-minute job. But actually it is a month's job. So to cut the long discussion short, if today is February and you wanted to do a leverage buyout deal in August for a minute, or maybe in September, or maybe in October, you need to start in March. And even that, you will start in March, you are not sure whether this would end up positive or this would end up negative. You are not sure about that. This was our version of leverage buyout. As Treasury Consulting is heading as an investment bank, we are adding a lot of videos about investment banking. We envisage to add good videos, good quality content on the YouTube. And sooner our investment banking would be on the card, and we will let you know. You know my mobile number, which is +91 9899242978. You know our fixed income platform, www.fixedincome.global. Have a great time. At onset, we thank you very much for watching this video. The purpose of the Treasury Consulting Group YouTube channel is to spare a lot of knowledge, and that too practical knowledge in the public domain. We feel that the current education system in majority of the countries of the globe believes in degree, but we believes in knowledge. People often ask what Treasury Consulting does. Treasury Consulting is a Singapore multinational headquartered group wherein we currently have 3 legal entities, which is Singapore, India and Hong Kong. Eventually in this year we are planning a British entity and 2 OBRs, which is Overseas Bank Representative, which one in Germany, one in Greece tentatively. On knowledge front, we do offer a lot of stuff. We are having our fixed income platform, www.fixedincome.global, wherein around 62 plus live trading desks are there. And by December 2021, which is approximately 2 years from here, in a phased manner, about 100 plus, which is about 38 more will come. So in another 2 years, around 100 plus desks would be live. We do have around 200 plus training courses covering various topics which are available live on our fixed income platform. Currently we offer in 5 parts, which is functional trainings, forensic trainings, regulatory trainings, information technology trainings and technological trainings. More trainings are coming. Apart from that, we do offer MTM desk, which is mark to market of derivative, consultancy, project implementation, treasury management system, almost everything which we are coming, and more product domains are coming. On a knowledge basis, Treasury Consulting hold our Hedge Fund Academy, which is 182nd platform. We hold our Audiobook Academy, which is known as Audiobook. We are coming up with our OTT platform, which is over the top, which we titled as TRFX. And it would be completely different than we have Amazon and Netflix due respect to both companies. Our investment bank, hedge fund, it is also coming. More importantly, we operate 44 plus WhatsApp groups, and where we cover the books, the magazines, the bank research reports, I would say the GST, the corporate finance, the educational videos, the treasury, derivative, financial markets, synthetic derivative and whatnot. All these 44 WhatsApp group are linked with the thread. So if a member of one group wanted to join another group, he can freely join that group. There is no. We do operate almost daily derivative email. You are welcome to join our group, but once again this group is subject to invitation and we will see your profile, we scrutinize your profile. So it is not for all, it is based upon the people, those who hold good profile. But if you have a fire in you and we see that you wanted to learn something different, we will definitely give you an opportunity to join. More importantly, my mobile numbers, which is +91 9899 242 978. My alternate number +91 9818 485 155. Both are in the public domain. They both are on WhatsApp. You are welcome to WhatsApp me at any point of time. Do not forget that we are the only platform when it comes to private placement, and there are so many things we are offering in private placement and many things which we are adding. Overall, Treasury Consulting is currently a Singapore multinational headquarter group, which would soon be London headquartered group, and Singapore would be Southeast Asia headquarter for Treasury Consulting. Our fixed income platform www.fixedincome.global cover a lot of information. We once again thank you very much for watching our videos, and we assure you that our both YouTube channels, which is Foreign Exchange Maverick Thinkers and which is Treasury X, and our TikTok channel would continue to grow. We are expecting around 6,000 plus videos only in 2020 and around 5,000 plus videos next year onwards on YouTube. And God willing, by 2020 December, we would be crossing hell lot of videos. Have a great time, and we once again thank you very much. And our ambition of becoming or serving you or giving you a knowledge which books even do not give would continue. Have a great time.